While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic development.
So they cut 25 basis points.
Yep.
Not the most exciting Fed presser I've ever seen. I'm spoiled. We had the Powell pivot, 2018 with Volmageddon. We had February 20th, right before COVID lockdowns and all that. Those were some exciting. Those are Breaking Bad level Fed pressers. This isn't like that. But this is like top 20. I'll take it because the Fed clearly didn't want to cut because they only came in with 25 basis points. I know that's what the market was pushing, but there's all kinds of reasons why they should have cut 50 and they didn't, which makes the questions that we're going to see today actually pretty interesting.
Is this 25? Does that confirm that the Fed is political?
I think it has to confirm that the Fed is political. I want to revisit that after you have a chance to hear Powell answer some of these questions. Because as you can imagine, the press corps is like, okay, what? Why not 50? It sounds like you're saying things are bad. And
I'm betting
they were bad before. So what's happening?
I'm bending one knee, not both knees.
The first one, they're addressing the idea of why no 50 basis point cut?
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
Great question.
There wasn't widespread support at all for a 50 basis point cut.
Lies.
No, of course there wasn't.
He whispers lies.
Today, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well,
just keep in mind that the people whose job it is to know what these things, how these things move through the economy, the PhDs, the board members, the people whose job it is to focus day in and day out as to what would happen under all these different circumstances. He goes, well, we have to wait and see. So what you do at home,
right?
What you're doing, waiting and seeing, that's what they're doing. How are we supposed to know if the tariffs are going to cause prices to go up? Here's what we'll do. What we'll do is we'll wait and we'll see, did the prices go up? They didn't go up. PhD, folks. PhD.
Well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
All right. So he's like, no, we didn't consider a 50 basis point cut. Not even really on the table. We're wait and see. They're data dependent. Wait and see. So they're as good as an RSI indicator on your chart. They're coincident. The Fed is coincident. Fine. At least we know what it is. All right. Next up, the idea here is the Fed's credibility. This is the big term here, the credibility. The Fed has been aiming for a 2% average inflation rate forever, ever since you were inside your mother's womb. That's what the Fed has been aiming for. And they've basically not got to 2%. We're above 2%. They've not been at 2%. So the question comes up yet again, what gives?
Howard, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, that you're
Question. Yeah, Tom Hartman, Sacred Prophet. You're never right on any predictions, ever. You fail. We fixed it. Why should we believe you? Peter, what kind of answer do you think he can give that would make you go, you know what? That is a really solid answer. That actually makes a lot of sense why you keep making predictions 2 years out that never, ever play out. It's a rhetorical question. So nobody can answer that. Let's hear what he says.
You're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But
You're right. It does say we're going to get to 2% inflation by 2028. You're right. It does say that.
that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Okay.
Make sense?
So he says it. He says it right away. One, I don't understand. The exercise is that we have to put down what our prediction is. No one can predict what the economy is going to be like in 3 years. No one can predict that. But the exercise is that we have to. So we have to put something on the paper that says we think that if we did these things, it'll get there. So that's the answer to your question as to why we're credible, why you should believe us for what happens in the future. Because we're in the business of predicting the future, and we're not able to do that. No one can. It's crazy. But that's why. Great.
This is like when you ask psychics, hey, do something. Oh, it doesn't work that way. It doesn't work that way. No, I can't just read your mind. Yes, I know I'm saying I'm a mind reader, but it doesn't work that way.
It's a sensing of the future as it is right now. But as things change, the future changes. So what's the value of your prediction? Well, you get an idea of what we think right now about the future. Oh, okay. All right. And the last section here, this is all about the QCEY. This is the census for employment and workers. The whole thing about the jobs numbers that were widely off. Right, the jobs numbers have been widely off by hundreds of thousands to millions of jobs that are not there that the Fed thought was there beforehand, and for which they're using this data to set policy. Remember, the Fed is setting policy based on data, the data dependent. The data that they're collecting is late or outdated or wrong. So then when it gets updated, the question is, okay, so then why don't you change your policy based on what the data should have been back then? And they go, because we got it now. Let's hear what they say.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can
911,000 jobs down from the year before, revised. That means there were less than that. 911,000 was not there last time when we were making the decisions. And also in June, we also had a negative revision. So not only last year, but also recently, also the numbers are off.
How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model. because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Okay, I don't get that answer. He goes, 51% of the jobs that you thought were there last year are not there. Had you had that information back then, would your policy changes have been different? Look, we can't drive backwards. Can't look in the rearview mirror. We got to make the decision with the information that we have.
It's worse than that. It's worse than that, Tom. He said two things. He said, look, well, hey, come on, we gotta look back. Well, hindsight's 2020. But what he first said was, it's remarkable. Our model predicted this revision. It sounds like what he was saying is, we did know the amount of jobs that would be revised earlier. So which one is it? Do you have a model that allows you to know how much they're overestimating, and you knew back then what the right thing was? It's remarkable how close we got to it. Or are you living life in the rearview mirror? And if you knew it back then, why didn't you cut? And send Jerome Powell to the BLS. Let him do the Bureau. If they can model it and get accurate, why the heck are they not updating them? How is it they're getting the right numbers, but the Bureau of Labor Statistics are not?
He says it's not a big problem. We know what it is. We know what to do. They need the resources in order to be able to do it.
This is like watching someone run for office. This is like listening to a politician speak. I mean, could you make heads or tails of what he was saying? He's like, how can I get through this conversation without actually saying or committing to anything with any force? Right. There's no edge. Honey, where were you? Where were you last night? Look, sometimes we're places, sometimes we're not places. Like,
exactly.
I don't get it.
What I wanted to hear is, yes, we understand that that's there, and we actually cut accordingly. This is where policy would be. Were these jobs not there last time? We actually would be cut in the exact same way. That's why we don't have to do any emergency thing. Our policy is matching that. That's not what he says.
That's not what he said.
Look, the data comes in sometimes slowly. We know what to do, how to fix it. We can sort of we understand how much we're off. We didn't let you know about that. We didn't say, hey, but guys, you know that report's going to come out tomorrow? Don't move the markets on that right away. You might want to wait. It takes about 2 months, 3 months before we can get all the results. So don't even look at it now. No, that's not what they're saying. Okay, fine. Look, that's what it is. Let's just finish this with the expectations that they have here. By the way, this is the equivalent of grilling the Fed. Right? It's not random people. It's not me and you can walk into the presser over here and start asking questions. So if these are coming out, these are pretty pointed questions. He doesn't want to have to answer these questions. I'll tell you that.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy
Market, we work through expectations. All right? So now let's set it to rest. Let's just put it to rest. This is something that Jeff Snyder from Uredall University has been talking about this whole time. The Fed is an expectation-based system. The rate cuts are not the main show. That's why the guy was saying, what's 25 basis point going to do? There's problems with entry-level workers, problems with AI, problems with the immigration, the problems with all these jobs in the sector. What is 25 basis points going to do? It was, well, nothing. But the market has already been pricing in what they think will do in the future. It's an expectation-based policy. The reason why this is happening, the pressures are happening, the Fed speaks, is so that you, the market, you go and you make modifications to the market, to your position sizes accordingly. That's what it's all about. All right? I just wanted to show that he said that right there. He said it.
Jerome Powell says the quiet part out loud.
I'm going to play this last clip here, which is about the bubble in the market.
Rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
You know, we're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, you know, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
All right. There you have it, folks. The Fed is not concerned with bubbles. They're concerned with volatility. He goes, we're looking at it and we're going, are there any structural problems? He's not saying structural problems to the upside. He's saying structural problems to the downside. The thing within a market making all-time highs consistently all the time is that it's remarkably not volatile and beneficial to the system. Monetary inflation, asset price inflation is good. Low volatility. So he goes, hey, we're here for full employment and stable prices. It's stable. All-time highs is stable. What's the problem? So basically he's like, no. He didn't even say the word bubble. No. Look. He goes, look, sure, poor people are suffering. But if you add in non-poor people and rich people, the aggregate, households are doing fine.
I don't know if that's exactly what he said.
That's what he said. He said he goes, households are fine in the aggregate. Yes, lower income are suffering, but on the aggregate, households are doing fine. That means if you add in the non-poor people, then the average or even the median is fine. That's what he's saying.
All right.
So he goes, we don't see a problem. The poor will always be with us.
I think you're adding
5:16.
I think you're adding color to what he's saying.
I'm translating Fed speak. All right. They're not here trying to tell us exactly what's going on. They're trying to tell us what, like he said, expectations. He wants us to behave in a certain way, which I appreciate. Thank you for being transparently opaque. Peter, that's it for our Daily Bread today. I want to hear what everyone else thinks. I want to hear what you think. And if you've been forward guided in order to move the markets in the way that the Fed needs you to do it. Are you going to do your duty? Buy that market? And buy higher to sell higher? Or are you pulling your money off the table going, I don't like this Fed pressure. I don't like the way that this Fed speaks. Let's use the chat as an indicator so we could put money behind what people actually think. Leave it in the chat, and we'll be back tomorrow with another Daily Bread.